Okay, and YouTube's stupid live streaming software just put me live without another start live streaming button. Good job, YouTube. Also, YouTube customer service on Twitter, absolutely horrible, as usual. So, the gold price is above $2,000 an ounce. It went above $2,000 an ounce. It closed above $2,000 an ounce. And it is about fucking time. Yes, I'm going to drop the F-bomb. It is about fucking time. It should have happened a long time ago. Many, many, many years ago. But the bullion banks and the other manipulators knocked it down, played tons of paper games. The games that were played in 2011 and 12 and part of 2010 were insane. And there was a lot of games along the way. And then the gold bears, just made fun of the gold bulls for a very long time. And the bear market lasted a lot longer than it should have. And hardly, really, no bullion bankers went to prison, although now there is a RICO investigation, but none of the high-level banksters, the bullion bankers, involved in the paper price manipulation scheme, none of the people at the top are probably going to go to prison. It looks like they're rolling up the lower-level people and the mid-level people. They're going to throw us a bone. A few people go to prison. We'll see what happens with the RICO investigation, but this has been ongoing for a very, very long time, 20 years, according to the Gold Antitrust Action Committee, or GATA, the paper price manipulation scheme. I've been up in Toronto at the Sprott headquarters twice. I've had conversations with Eric Sprott about when they first found out about the paper price, gold and silver paper price manipulation schemes. It's been going on for a long time. And the people who first found out about it do not want to talk about it, and I won't say exactly why, but it's clandestine, let's just say, from what Eric Sprott told me. So, the Muppet masters at Goldman Sachs Wealth Management, they've been telling their clients now for over a month that it was too risky or stupid to invest in gold and silver. Meanwhile, I'm sure they've loaded up on gold and silver stocks and gold and silver up the wazoo, and their clients again got the the royal shaft. Not the fun. the Muppets got Muppeted again. So Goldman Sachs, there was an article that came out in the last week saying the head of Goldman Sachs Wealth Management said his clients should not hold gold. Has anyone looked at a gold chart? Has anyone looked at central bank balance sheet expansion over the last 6 or 7 months? Has anyone looked at the M2 money supply or the Austrian true money supply growth that's happened? There were all these signals that there was problems, that the gold bull market had restarted. Go and look at the chart of the gold price, the silver price, and the best gold stocks during that margin call, that puke point, that liquidation event, the first 10 days or so of March. There was enormous dip buying. And if you go back into the charts of the best gold stocks, there is dip buying pretty much all along the way up. Only someone who was lying or doesn't know about investing or trading would acknowledge that this was not the case. So now that we're above $2,000 an ounce, it got to 2021, I think, and now it's, let me pull it up, it's 2015 right now. So we have our first gold close above $2,000 an ounce. We need a couple more, probably 3 or 4 days, according to some technical analysts, where gold can make an even larger move. But I wanted to talk about what a Giffen Good is. So I have the definition there on a screen of what a Giffen Good is. A good where a higher price causes an increase in demand. So it's counterintuitive. It's not the normal supply-demand fundamentals of a commodity where price regulates supply and demand. So normally with a commodity, the higher the price, demand is going to decrease, or there's going to be alternatives or substitutes that come. And this is not really the case with gold, although you could say, I guess, that silver is a substitute for gold. So I think the average Joe or Jane on the street, is going to notice at some point, if they haven't already, that gold and gold stocks are going up a lot, that gold is going at some point in the not too distant future to 2100, 2200 higher, and the average Joe or Jane will probably not be able to buy an ounce of gold or even some of the best gold stocks, but they will be able to buy some ounces of silver and probably some silver stocks or maybe some juniors or some gold or silver mining ETFs. And I have there on the screen a hedge fund manager Wall of Shame inductee. He actually had an Ask Me Anything on his Twitter a couple days ago, and this should be a lesson to you guys out there on social media, that if you have 40,000 Twitter followers or you have a large social media following, do not do an Ask Me Anything, because I remembered that he said he was bragging that he shorted gold. And he could not have shorted gold at the worst time, because he totally missed that. I heard he's also short silver. So I just tweeted to him on Friday, Thomas Thornton there of Hedge Fund Telemetry. I think he also worked at Long-Term Capital Management, but he did not work in the derivatives department, the OTC derivatives division, from what I heard. He was at like the profitable hedge fund trading division. But I just asked him under his Twitter, like, are you still short gold? And I was blocked in 10 minutes. So I'm blocked now by Jim Cramer. I'm blocked by Thomas Thornton of Hedge Fund Telemetry, just asking him if he was still short gold. I mean, I didn't do any crazy trolling there. And then blocked by Marin Katusa. I guess you're not allowed to talk about his best friend's connection to the Clinton Foundation. Anyway, okay, so about the Giffen Good is an important thing here, and that could actually counterintuitively, now that gold has broken the important $2,000 an ounce psychological barrier, if gold continues to close at or above $2,000 an ounce, this could increase the demand for physical gold and gold stocks. So we shall see what happens. I think the paper price manipulators are not done. I think they will try additional games, but it looks like the games that they have tried for the last couple months have not really worked. So there was attempts to knock the gold price down, I think, in the last couple weeks, and maybe it lasted under a week. So I think the correction in the gold price where it went down, I think it lasted all of a week or so, or under a week, excuse me. And a couple days ago, we had a record amount of physical gold delivered to the COMEX. And hedge fund manager Tavi Costa, who is a friend of the show, he is a podcast listener. He is a listener to the YouTube channel here. He put out an interesting chart a couple days ago on August 1st about how much treasuries the U.S. federal government needs to issue. Average maturity of outstanding government debt just plunged to only 64 months. Bottom line, a tsunami of 8.5 trillion of treasuries will be maturing by the end of 2021. And that means the U.S. federal government, the U.S. Treasury, has to issue, either roll over or issue, an enormous amount more debt. So that means the Fed's probably going to have to monetize it, because the global economy is not functioning properly, where other countries that are trading with the U.S. that are earning dollars in trade can recycle those dollars back into treasuries, because the global economy is not functioning well right now. So that means the Fed probably, unless they can convince more pension funds. So the gold bull market will continue. It's going to be volatile. There's going to be big ups and down moves along the way, but it is very clear if you look on the charts of the top gold stocks or the best gold mining ETF, which is GOAU, GOAU, which has the royalty and streaming companies in there, the largest ones, and then also like a handful of some of the best gold miners. The dips are being bought aggressively, especially since March on those charts. I also, before I wrap this short little live stream show up, I wanted to talk about some warnings about owning individual gold miners and the problems that some individual gold miners did in 2010 and 2011, and red flags and warnings to watch out for. So Kinross Gold did a really bad deal. I believe it was Kinross. In 2010 or 11, I think they paid a unbelievably high valuation for an acquisition to add growth to their pipeline. I think they paid, when the gold price was almost at 1900, they paid for gold in the ground, for gold reserves, before they had to spend hundreds of millions or billions of dollars to build their gold mine. They had to pay the miner to acquire them, just the property, before they actually built the mine, which is enormously high capital expenditure. I think they were paying $1,100 an ounce for gold reserves, which is nuts. So normally gold in the ground, gold reserves are extremely heavily discounted in a bear market. The gold reserves in a bear market for an undeveloped mine that might be a little bit higher cost and would be economic at a higher gold price, you might be able to get the gold reserves for well under $100 an ounce. Sometimes it can go for under $50 an ounce. And sometimes in a bear market, you can get silver reserves in a deep bear market for $1 an ounce or less. So that was like, in hindsight, those were the assets to buy back then. But you have to watch out for the mining company, the gold miner, that is too aggressive about trying to overpay for bad deals. So you had in the last gold bull market in 2010 and 11, before the paper price smashes and the bear market started for I would say 7 years, you had really bad deals towards the top by Kinross Gold, by New Gold, and by Barrick Gold. Barrick Gold even bought a copper miner. So Barrick Gold did so many bad things in 2010 and 11 and 12 and 13. I mean, they wrote off, I think, over $7 billion in bad deals. And Pascal Lama is still like a problem for them. I think they cut off all the spending for that, but it's still a mess. So you have to watch out for that. You have to watch. You're going to start, if the gold price continues to go higher, you're going to see some of these gold miners want to add growth. You want to see the valuations, how much per ounce in the gold reserves, or measured and indicated, is the gold miner buying the next gold mine to develop for. So are they going to be paying $1,100 an ounce or $1,200 an ounce or $1,500 an ounce or higher for gold that they still have to spend an enormous amount of capex to build a mine on? If they have to do that, and then there's problems at the mine, they could get in trouble, just like with New Gold. And that was my other case study I wanted to talk about, was New Gold. So New Gold wanted to add even more growth to their growth pipeline. I think it was 2011 or 12. They bought this development project called Rainy River, and it was just a boondoggle of a project. The costs were enormously overrun. New Gold almost went bankrupt. But before they bought Rainy River, they were really well respected. Pierre Lassonde was on their board of directors. They had a really all-star board of directors. And they had, I think, a handful of really good mid-tier gold mines that were producing at fairly low cost. They were doing a good job, and then they got greedy. So they bought Rainy River, and then the overruns, the construction costs and cost overruns. The mine was not on time and on budget. The grades were not where they thought when the mine was getting close to being ready, and it was just a mess. So those are the things you have to watch out for. You have to watch out if, when the miner does do an acquisition, are they overpaying for the valuation on the ounces in the ground? Because then they still have to spend all the construction capex before they get a profit. So there's depending upon how big a gold mine it is and what gold price we have, the payback period for some of these mines could be many, many years. It could be 3, 4, 5, 6 years, which is a pretty long time to use debt and borrow a lot of money. And that's what a lot of the miners do. A lot of the miners do not fund growth of new mines just from free cash flow and just by issuing shares. And then the other red flag is the mine coming in on time and on budget. That's always a big worry. So if it's a really big mine, even a small mine like America's Gold and Silver had enormous problems with Relief Canyon before the pandemic. So Sandstorm Gold didn't have to worry about those construction cost overruns and all the extra share dilution that America's Gold and Silver has had to do. Now, America's Gold and Silver has been able to raise the capital, but that mine was supposed to be at commercial production, I think, in November. So it took, many months longer. Even without the pandemic, it was having a massive amounts of problems. Now, it seems that they've gotten through those, but, shareholders along the way, there was a lot of ups and downs, and I'm sure shareholders of America's Gold and Silver were not happy about all those share dilutions that were done. There was quite a few of them along the way. So I think this next leg of the bull market is just getting started, but we'll see. In my opinion, the dips are being bought. A lot of Main Street investors, so like your Davey day trader types, I haven't heard him on a live stream show talk about gold stocks yet. That will be a sign that the crazy blow off top mania starting. So when Dave Portnoy of Barstool Sports and Davey Day Trader Global starts talking about all the gold stocks he's buying, and then his millions of social media followers start buying junior mining stocks and gold stocks. But you have to be careful, though, because the fraudsters in Vancouver, they're coming out of the woodworks now. They see blood in the water. So there's going to be a lot of junior mining companies that are going to raise a lot of capital, most of them out of Vancouver, and a lot of the capital they raise is not going to be put into the ground for their drill programs. It is going to be spent on, lavish trips, paying newsletter writers off, some of them, paying off some newsletter writers to do pump and dump where the newsletter writers don't disclose that to their own paying customers. Or the mining executives at the junior miner, they're flying first class or they're taking a private jet to a mining conference to raise even more capital, and they're paying for expensive dinners, wining and dining, and nightclubs with bottle service and suites, hotel suites, 5-star hotel suites for themselves and for others to help promote the stock. So there are red flags. There are ways to figure this out. I talk about this on the Mining Stock Education Lecture. That is for free. On the playlist, Mining Stock Education Lecture Series playlist on my YouTube channel. And I also talk about this at length behind the paywall on my Patreon account articles. So it is fun times for $2,000 an ounce gold. And I suspect it's going to get even more fun. Now, this also means that we're going to have more inflation, because the Fed has released statements recently that their goal is even more inflation. So stagflate, tax, and lie, they will not allow deflation in a fiat currency and credit Ponzi scheme. They will change the rules. They will do bailouts. So there will be a lot of rules changes and bailouts along the way in this fiat currency and credit Ponzi scheme to try to stop deflation. And Keynesian economics doesn't like deflation anyway. Okay, well, I don't see any super chats here, so that's it for this short little live stream show. I just wanted to talk about some of the basics here for gold and silver. It is a Giffen Good. Gold especially is a Giffen Good, and silver in a lot of aspects for investors will pick up some investment demand because the gold price is going to be too high for a lot of Joes and Janes on Main Street. So silver will benefit from this. There will be more people buying silver, getting silver exposure that see the gold price going higher. So gold is the Giffen Good, and silver should ride the coattails up. So silver, the gold to silver ratio, silver should start to outperform now because more people on Main Street are going to start buying more silver exposure, I would expect.